This is Practical Pivots, the podcast for startup leaders, founders, and investors asking, how do we find that next growth wave? Join me for sharp conversations with an eclectic ensemble of experts to guide companies to disrupt the undisruptible, turn setbacks into scale-ups, and transform plateaus into pivots. I'm your host, Steve Pockross. This week, I'm talking with John Allen, CEO of EzaLife, a medical device startup focused on optimizing post-surgical recovery. John is a serial scale-up CEO who specializes in taking over high-potential, early-stage companies, infusing them with go-to-market magic and the capital to fuel them, and then taking them to exit. A feat he's done multiple times. As a CEO has done this one time, I frequently look to John for guidance, as this is not the path most followed. John has spent his career working with companies at those pivotal moments when the original plan stops working, when growth stalls, markets shift, funding dries up, or the strategy that once made perfect sense suddenly doesn't anymore. In this episode, John and I dig into questions like why growth plateaus should be viewed as expected, not as a surprise along the journey, the difference between a smart pivot and a desperate flail, and why most of the best companies aren't built from perfect plans, but from well-executed iterations of those plans. Almost every startup eventually has to change direction. The real question is how you do it. Let's talk to John. John Allen, welcome to Practical Pivots.
Hey, Steve. How are you?
Good. It's great to finally have you on the show.
Good. Glad to be here.
Let's start with the basics. How do you describe what you do to mere mortals?
To mere mortals, I say I am hired by investors to go in and run companies that they're excited to put their money in, but like to bring in people maybe they've worked with before. So I often work with the same investors.
So as someone else who also scales up other people's companies, once they start it and turn it into an uncut gem, it comes with its own sets of opportunities and challenges. Why are these ones better than founding a company, in your opinion? I have mine.
I think your relationship with the formation of your board is extremely important to me, and just the relationships that you have with your board and your investors, and they're not necessarily the same people, as you know, and they should not, nor should they be all the same people, but the relationship is just different in terms of how you companies I've gone into and I've watched, the founders, even after years of a relationship with an investor or board member, they're going into these meetings terrified and in sales mode and trying to pitch it's just like a sales pitch, and you're like, man, you've known that investor for 6 years now, and you still are not a partner with them. And I just find when you're investor appointed, you just, I don't know if this is the right term for it, but you sit on the same side of the table as the investors are still your bosses and still deliver, but you're the kind of culture that you have of a safe place to speak about issues and get advice and present a plan and get support for it. It's just different than how I watch founders go through that relationship.
Yeah, I like that. Instead of where it's a confrontational relationship where you have to constantly be convincing them you're doing a good job, you can actually get advice from your investors, and I like that. Be on the same team, as you said.
Yeah, absolutely on the same team. And one of the chairman of one of the companies that I ran was the former CEO of a massive, 80,000 employee company today or whatever. But really fantastic guy. And he said to me this the first day I met him, and he reminded me of it a few times, and then went through a phase of praising me for hearing what he said all the way. He would say, just, John, no surprises. So that's all I ask of my CEO is no surprises. And that's something that founders really, really struggle to I don't know if it's understand or just have the relationship with a chairman or whoever it is, board appointee from a VC, is that they just don't feel safe to bubble up the surprise or bubble up the issue early before it becomes a surprise that has to be talked about.
Yeah. Let's talk about how you make your decisions on what companies you want to work for next. As when you're looking at a potential company to take over, non-negotiable signals that tell you this one's worth your time?
So, and I guess it wasn't always like this. So, I mean, the first transition for me was I sold in my own company. I sold majority interest to a fund, private equity fund, private equity / hedge fund, and they were investing into an early stage company which they didn't do much of, and they thought, okay, you've brought this company up to whatever $10-15 million, depending on what exchange rate you want to use, today's or back then. So you've done that. We got our team to go in here, but we want to invest in this company. We'd love to reset you back in your, go back to pre-revenue again and run it all over again, pre-revenue to that 8-figure sum. And so that was not necessarily me looking, but then that evolved over time to me looking, and there are times when you're just looking, right, and it's like, okay, this is the time to get a job, not B job, and then they often it's a lot of it is serendipity. You just randomly get a call from somebody who says, hey, I met somebody yesterday and I thought of you. They're looking for somebody to run such and such a company before they write a check. And so there's a lot of that. The last, the more recent times, it's been much more running a process. And so, I have a HubSpot instance that's 10 years old now that's got 197,000 contacts or something. I think there's 40 or 50,000 of them are investors of all shapes and sizes. And I, just ran a campaign like any other campaign to try and get the right conversations going. I mean, I don't look for the companies. I look for the investors. I guess it's a short answer. And the investors, again, because the relationship you have with them is not necessarily selling to them. If I get on a call with a fund that invests, I mean, there is some pre-qualification in terms of stage they invest and etc. But at the end of the day, the conversation with them is a partnership. I'm not pitching to them, hey, I should come work for you. It's like, hey, what do you got in your portfolio? And mostly the way those conversations go is they say, yeah, I've got 2 or 3 things we take a look at and tell me if they're of interest. And sometimes things are interesting and sometimes they're not. And then the ones that are interesting, I put my work into them like an investor would put the work into the diligence before they decide to put in money. If I'm going to, I'm on a 4 or 5 year cadence. And so if I'm going to put 4 to 5 years into that, and no surprise, 4 years is how long it takes to invest and start thinking about an exit cycle. But if I'm going to put another chunk of my career, especially as I'm now, in my 50s, and the 4 or 5 year gigs, there's not as many left as there were when I was 30. And I really put the diligence in before I decide. And that's all the checkbox that an investor will do, in terms of the team. The team for an investor is pretty focused on the management team. I'm surprised more investors don't actually put any emphasis on what does the board look like, right? And so they're not like, well, who am I going to be sitting on the board with? Is that a board member that's, they never background check another board member, right? They'll background check the management team, but they will never say, okay, the board has got that VC and that VC. I haven't worked with them before, and they, call their friends in, the valley and kind of say, hey, what are they like? Say, oh yeah, we co-invested with them before. What an asshole, right? But for me, it is important. I can't, not do my own background checks on who's involved and who are the investors and what I do. And I like the model that the venture banks use. I don't practice it in the same way, but also venture banks will run their algorithms that say that company is bringing in a Series B from these 3 VCs. Their track record is they tend to let a company close long before they'll put bad money behind bad money. We're not going to give them as much venture debt as we would a company where their portfolio of investors has a different way of operating when things get tough in a company. And so you have to look at it with all that lens. But I'm also not I'm not as transfixed maybe as like a VC investor would be. Well, what's the team? Because generally, if I'm going in, the team that's there, it's not necessarily the team that's going to be there in 6 or 12 months' time. Mostly by self-selection.
Got it. All right. So you've got your green flags, which is number one, an investor that you trust says this is a good company. So you've got the trust of the people. The normal red flags, which is the management team, isn't that critical for you because they can come, they can go. This is part of the normal transition pivot process.
I have never been part of a coup. Like I have never got a call from an investor saying, I'll meet you here because I don't want the CEO to know I'm meeting. It's never that way. It's never the, and it was that way before. 10 years ago, the 2 board members would leave the boardroom, right? There was no Zoom back then. They'd get in their cars, and VC1 would ring VC2 and say, "Hey, we got to get rid of that CEO. Who do you know?" Right? And they do all this kind of stuff, and then suddenly they mark the CEO and say, or we are going to put the next money in, but you're out. That doesn't happen anymore. That happened 10, 15 years ago. And so what happens now is I am always brought into the conversation, and the CEO is always either self-selected or accepted that they weren't the CEO long before I brought into the conversation.
All right. So you come into another new company, you've selected what you feel like is a good one. What's your order of operation, quote unquote, playbook? Or do you, how do you go about, in instigating this change and even figuring out what's the right time to keep thinking versus doing?
So my playbook starts as part of my diligence process. It's not, what's the first thing when you walk in on a Monday morning and put your, briefcase on the desk and say, okay, here we go. For me, it happens much sooner than that. It's the building out of the financial model. I'll invest the time in building the financial model of the company. And so the first part of that, like, as you know, is the revenue model, and then you build out the cost model. You start building the revenue model, allows you to understand, what does this company need to have or achieve to be successful. And, there's other ways for people to learn a business. When I am building a model and I'm now, inserting another 2 rows, the bottom row is the new piece of data, and the row above it is the percentage that's telling you the conversion. As I'm doing that, I'm like, okay, so for that business to succeed, it's got to actually, be able to convert from there in the funnel to there in the funnel. What does that mean? I have to build the model to understand what are the things that it needs to have, do, or work around, figure another way to get there. And that's how I learn about a business. I learn it from the Excel.
Got it. So you're coming into one of these companies and you've already met a lot of the management team ahead of time. One of the biggest challenges that I have is figuring out, so there's so many areas of expertise you can have. And the weirdest thing about being a CEO is for the rest of your career, you get promoted because you're really good at what you do. And when you're a CEO, you now run all of the groups and you pretty much suck at 7 out of 8 of them. And there's only one of them that's your area of expertise. So how do you figure out who to trust and which voices to listen to?
So I have a kind of strong belief in the kind of the tide rises all boats, but not necessarily all boats. And so you have the folks that are happy with their boat, and they're happy about maximizing their boat, and they've spent their career being the best, I don't know, VP of sales, or the best, engineering, or whatever. And when the tide rises and the company starts to scale and succeed, or maybe 3 years ago it was just getting funded, right? And it was just getting like a ton of venture cash in there, such that suddenly that group of 3 people was going to be 13, and everybody kind of, there's people who will just be able to rise up with it, or there's the people who just, they didn't look after what they were doing either in their previous career or in how they approached what they did in the year or 2 before that, and they've got a leaky boat, and you spot them a mile off the people who are just not right. You know,
Got it.
when I start in a company, I invest a huge amount of time and thought into the founders and what they're going through. And like I said, in the last X years, so much of it is about uh, the self-selection. I had one founder a long time ago, 15 years ago, was just, you know, hostile and toxic and da 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 da. But for the most part now, it's people who are really happy to see you, but also very nervous to see you. And they're worried about losing their job, or they're worried about, okay, here I go, professional CEO coming in, I got my mitts up, and they're like, hands down from it. Let's just talk. What's life been like for you for the last year? And I've had, and even before I've started, even just in the process of talking to companies ahead of selection, and commitment, I've had CEOs break down in tears all the time, and just like, I just can't do this anymore. And they've got the company, it's at 2 million, they've got 15 staff, so it's okay that the lights stay on, but barely, and they've got investors that might bridge them, a couple $100,000 when they need to, but they don't see a way out, and they don't see a way forward, and they don't see a way out, and
Yeah.
they are extremely tired, and their spouses are tired, their co-founders are tired, and so I do invest quite a bit of time into understanding what it is that they want out of all this. And very few of them are like, I always thought this was going to be $1 billion company. It's still going to be $1 billion company. Now they're like going, if this could just be a $50 million exit that we all cleared our mortgage, that would be a great result. And it's like, well, okay, that tells me a little bit of something about your faith in whether it's me or a different outside CEO can come in, what a good result is. So it's kind of an interesting conversation.
For sure. Do you have some quick wins that you always focus on when you come into new companies, especially on the go-to-market side?
Yeah. So it's kind of funny because I don't I don't spend a lot of time reading up on things. So what I say now might seem as new, when in fact it's probably dated, and if not outdated. But I'm a big believer in RevOps, right? I just such a belief in having the right MarTech stack and the right kind of framework around what you're doing and go to market. To my detriment at times is sometimes it's like people say, well, let's just put it out there and see what happens. And like, well, shouldn't we be having like UTM codes in there so we can track the XYZ? And it's like, no, we just know fast enough. So at times I can over-engineer the framework building, but it is an important thing for me is to kind of say, okay, what are we doing? What tools do we use? How do we use them? And it's not even necessarily about the tactical side. It's more that culturally, if everyone's like, well, we just we don't measure that, or we don't automate that, or So for me, that's kind of the thing, is to say, okay, what are we doing with 10 people that we could do with 5, and what could those other 5 people be doing at the time?
Got it. And so the focus on RevOps is you're systematizing and automating all of your marketing sales functions in a way that a lot of smaller companies just do much more on personal relationships and spreadsheets as opposed to turning into an actual marketing program. Let's talk about EzaLife. What drew you to the opportunity, and what problem are you guys uniquely positioned to solve?
So I guess the vision for EzaLife is that almost like, and again, I'll show my age here. Imagine it's a scene in ER or Grey's Anatomy, or today, what is it, The Pit, which I haven't started watching yet. But imagine it's that show, and they come in, and they're all in their scrubs, and they got the patient has come in for their regular checkup, or being discharged, or just come out of post-op, or and they put their hand up on the shelf, and they open the pack, and they take out the thing, and they just do that every time, and it's just this like disposable, repeat again use of the product. What EzaLife's category, and it is creating a category, is disposable securement devices. And so, they're all or they all will be, little plastic devices. This is the first device we went to market with. We're having a great first run of it. Went to launch last August. And this one is for securing feeding tubes. And so it basically just stops kids in the middle of the night ripping out their feeding tubes, and they call it feeding the bed, right? Or if the extension tube doesn't come out when they feed the bed, it just pulls the actual whole thing out of their stomach and they have to go to the ER. And that happens, almost every child at some point in time in the first year of having feeding. And so now we've got this, highly precision engineered patented device that just, stops that happening. And we've got a whole, pipeline in the platform. EzaLife is a platform for these devices. We talk a lot about the feeding tube because that's the one, we're in manufacturing, we're selling it, we're going into hospitals. We're Medicaid eligible now, FDA complete, all of that kind of side. So we talk about the feeding tube, but EzaLife is really about the whole category. Our pipeline is surgical drains and CVAD devices for cancer patients, the line drives that they have, they get pulled out all the time. Ultimately, as we work towards, the big picture is they go home with the device, and a month later, when the nutrition ships out to their doorstep, the next month of formula for the baby, our device is shipping with it, and it's highly scalable.
That is truly amazing technology. That must have immediately appealed as far as a choice of a company that you wanted to get involved with. How does it respond when you start pitching it? Is this something that's so obvious that the people you're pitching it to know they need it immediately?
Yeah.
Or
yeah, I mean, we've spent a little bit, capital is tight in the market. We spent a little bit on Facebook ads and stuff. We've got our initial sales direct to consumer. People are taking out their credit card, or you can use your HSA card now. We're approved for that to buy it, and they go and purchase it. And our hypothesis and part of the whole vision for the platform is products that we can sell to consumers. Consumers become our ambassadors, and we now have a incredible inbound stream of. I just got off the phone to two nurses, pediatric nurses in Tennessee, and first question we always ask them on this discovery call is, well, where did you hear from us? And it was like a patient came in yesterday with wearing one of your devices, and they're like, we're so excited about this. So 50 to 6% of our inbound hospital inquiries are parent referrals, patient referrals. So you talk about people will talk about doctor referrals. We have the patients out there selling for us, and then they come to us and they're like, oh my god. And then the whole flywheel then is those two pediatric nurses who just got off the phone with us. The patient that came in right after that call is going to hear about our device. So it's just a beautiful flywheel network effect go to market.
Oh, it's so easy. It's too
yeah,
easy.
You wish.
Something has to be easy, because I know that financing hasn't been easy, and it's about as rough a financing market as I've ever seen. Tell me about your journey and how is it different this time from other financings you've done?
So we've got at it a very different way this time. I mean, like I mentioned, my first outside CEO appointment was a hedge fund, and I've always worked with VC and family office, and this time around was different in the sense that I have not worked in medical device before, and I don't have a network of investors in the medical device space. But I really was like really excited about this for all kinds of reasons, financial and otherwise. We had a mother this morning come on, and the issue she has, her daughter was born with no arms, and the issue she has is her daughter can actually get her legs up and pull the tube with her toes out, right?
Whoa.
And so to be part of being able to just get that person something like this, and changing they and their child's lives is phenomenal. So that got me hooked on the amongst the other things on the. I don't care that it's not my background. I want to see this thing succeed. But we went and did a roadshow to run to raise Reg D capital, and we talked to a whole pile of investors, and we've got a strong direct to consumer and network effect, flywheel, all of that kind of stuff that a certain investment community will get, but it's not the investment community who invest in medical devices. And then you take the people who understand net retention rates and subscription model and direct to consumer and all of that kind of stuff just don't understand medical device. So we started on I guess we started on a challenging path anyway, but then the markets, as you well know, are so horrible right now. I actually talked to somebody yesterday who works for a very big grant writing firm, and she said like the companies are just pouring in the door to them. Before it was like, yeah, grants are a lot of work. I know it's non-dilutive, but it's a lot of work. Now they're like, grants are, if we don't get this grant, we'll be in the next 6 months, we'll be shut in 12. So we got to about 6 months of running the roadshow and talking to the investors about this, and more we're hearing from people. Have you thought about crowdfunding? And it's like, that's just I don't know what it is, and B, again, it's like taking on something I know nothing about. It's actually not that complicated. It's just a different version of marketing, right? It's just your product is the stock you're selling. You're running through the various different campaigns, whether it's social or whatever, paid ads, whatever, to generate it. But the one thing I didn't understand about crowdfunding that explains maybe a little bit why angels are moving away from Reg D to Reg CF crowdfund. The Reg D that they've been investing in for the last 10 or 15 years has been very much the turn up at demo day and write the $25,000 check into the company. By the time you get to demo day, the people left on stage who are not fully subscribed by the people who run the demo day are the companies that they're the only companies left for you to invest, and generally those investments are stuck in the companies. And so if the company has survived 5, 6, 7 years after demo day, the money will never come out of that company. And that angel who wrote a $25,000 check, and maybe wrote 2 of them that day or 3 of them that day, and maybe did it every year, they're never going to see that money. They might get, if they're lucky, one liquidity event that has them break even over their Reg D portfolio of 20 companies at $25,000 a pop. Reg CF is different because Reg CF has an instant secondary market. When I say instant, it's instant within in the first 12 months, the stock can be sold on the secondary market of the platform. Like we use Start Engine, and so anyone who buys stock in EzaLife today can sell it tomorrow on their secondary platform. You just get your login, put your stock up for sale, and within the first 12 months, it has to be to an accredited investor. After 12 months, it can be to anybody who has a login. And so the liquidity of owning Reg CF stock versus Reg D is very, very different. And I think that, I think if angel investors knew that more, or more angel investors knew that, to say, well, look, if it doesn't all work out, I might break even and I can take my money out in 2 years. It's not like just stuck in there. Or if it does well and I want to cash in my profit and leave the rest there for my upside, I can do that in a year's time too, or 6 months time, or whatever. So it's definitely a thing that investors are probably not aware of, that they should probably be aware of.
Got it. What an interesting transition in the market. Do you have a crowdfunding site that's active out there? Do you want to share that here, and we can post it on the podcast notes too?
We can. It's we're on Start Engine, startengine.com/offering/EzaLife. But if you go to startengine.com and just click on the deals, they only ever have 60 or 70 deals that they will promote. And so when you go to healthcare, you find us pretty fast.
Great. Well, I really appreciate it. I have never had somebody who has really come from a similar scale up follow-on CEO situation as I have. So it was great to hear your different approaches and where we compare and contrast. Thank you so much for being on Practical Pivots.